Hello, welcome to the BBTrading channel. In this video, we want to discuss one of the moving average strategies. In order to be able to profit from the market, you have to learn the different techniques of that market. Today, you will see the highest level of moving average training. If you are seriously interested in learning the trading market, you can check out our free training videos. Also, if you think this video can be interesting for you, stay with me until the end. And click the subscribe button and like the video and turn on the notification to be notified when a new video is released. Leave a comment and tell us what topics you want us to cover and what you want to learn. Before I get into today's strategy, be sure to watch the money management and risk management video. What helps you in the trading market is money and risk management and mastery of market psychology and then strategy. Do you trade based on a trading plan or a specific strategy, or do you trade based on assumptions or emotions? Beginner traders only trade based on strategy without understanding the market. When they are in a negative cycle of the market or their strategy fails at that time, they say that the market is bad. When their account becomes negative, they want to take revenge from the market and restore their account. In this way, they empty their account. This is no different from gambling. Now is the time to change everything, even have your own rules for a strategy, make your own rules for trading in the market and stick to them. So whatever platform and chart you use, go to the indicators section and find the moving average and open it on your chart. A mistake that people make when trading is that they use these strategies on a small time frame. The first step is to select a time frame above, then select a currency pair. Now remember this very key point when using indicators. We never use indicators alone for trade analysis or trade entries. We only use it to confirm and support what we have already created with the price. We don't just enter and exit positions with moving averages. They don't give us entry trigger, we don't open positions with them alone. You must first learn price action or any trading style. You might be asking yourself, why then use a moving average? Number 1, moving averages can act as support or resistance. Number 2, moving averages is used to identify market trends and simplify price action. Number 3, it shows the change of trend from a bullish market to a bearish market and vice versa. With this in mind, we still do not use moving averages alone for trade entries, but rather pair them with the pricing we have already determined to increase the quality of trades. Let's start by identifying areas of support and resistance. The first reason is that they can act as a kind of support and resistance. There are two types of support and resistance, dynamic and static support and resistance. This is static support and resistance. Static support and resistance is a constant value over time. And this is dynamic support and resistance. Dynamic support and resistance, both time and price, are different and not fixed. In this strategy, we use 3 moving averages. So the specific moving average that we use, moving averages with lengths of 24, 64 and 94. A moving average is a simple technical indicator which calculates the average closing price of an asset over a specific time period. Therefore, the 24-period moving average calculates the average closing price of the last 24 candles. Moving averages are dynamic support and resistance. When we talk about support and resistance, we are talking about a fixed price level that the price is expected to reverse, but moving averages can act as a dynamic level of support and resistance in an uptrend or downtrend. Now, let's look at how to use moving average in your trading process. In a downtrend, we see that the price is currently below 3 moving averages. In this example, the moving average supports the price in 2 different positions. On the other hand, in a downtrend, we see that the price remains below the moving averages, and whenever the price gets close to the moving averages, it finds resistance. In fact, the price finds resistance from the 3 moving averages in total, so this is how the moving average can act as support and resistance. Therefore, we can look for selling opportunities near the moving averages in a downtrend. The reason for using these 3 moving averages is that they serve as a support and resistance range. Because support and resistance is not a line, it is a range. The reason we use these 3 moving averages is because they give us a range, and the numbers can vary based on your strategy. We do not consider moving averages as lines, we consider them as ranges, because it is mentioned in the moving average settings, that it should be set based on the opening and closing in the highest and lowest price and. On the other hand, in an uptrend, we see that the price remains above the moving averages, and whenever the price approaches the moving averages, it finds support. In this example, the moving average supports the price at 6 different positions. Therefore, we can look for buying opportunities near the moving average in an uptrend. If you liked the video so far, be sure to hit the like button and subscribe to our channel so you don't miss our next videos. Now, let's learn how to use moving averages to identify trends. A moving average is a trend indicator. Its main function is to help us identify price trends. Now, we have 3 techniques for identifying price trends in moving averages. The location of the price compared to the moving average can help us identify the trend. If the price is currently above these 3 moving averages and stays above it consistently, as a logical trader we want to trade in the direction of the trend, the price is considered to be in an uptrend. Therefore, we should look for buying opportunities. On the other hand, if the price is lower than these 3 moving averages and stays below it for a while, the price can be considered in a downward trend, and we should finally look for sales opportunities in this case. The reason for using these 3 moving averages is to identify the long-term trend of the market. This can help us make better trade decisions. In range markets, you will see that the price does not stay above or below the moving averages for long periods, but is always above and below the lines. In such scenarios, it is better to stay away from the trade and wait for a clear trend to develop. Beginner traders get lost in this range market and lose track of market trends. Therefore, they start trading against the market trend. This makes most of the traders lose their money. That's why we use 3 different moving averages with 3 different settings for better market analysis. When these 3 averages are intertwined, it means that the market is on the sideway and we are waiting for a certain trend to develop. Using these 3 moving averages alone and without price action will not bring you better trades. But, these 3 indicators will help you avoid bad trades. Bad trades mean trades against the market trend. Also, these moving averages can be a good indication of the strength of the price trend. Let's look at some simple examples on the chart. We have a steep upward slope. As you can see in the example, this upward trend has a steep slope and this shows the strength and acceleration of the upward trend. When the trend is strong, we trade with high probability. Seeing a gentle upward slope in an uptrend means that the uptrend lacks strength and momentum. When the trend is weak, we should be careful with our trades. And in a downtrend, we have a strong downslope, that is, our downtrend has a lot of strength and momentum. When the trend is strong, we trade with high probability. Also, seeing a gentle downward slope in a downtrend means that the downtrend lacks strength and momentum. When the trend is weak, we need to be careful with our trades. Now let's learn how to use moving averages to identify trend reversals. Note that in an uptrend, when the price crossed the moving average line, the trend changed to a downtrend. In a downtrend, when the price crosses the moving averages, we have a reversal to an uptrend. Remember that all crossovers are not signals and many of them can be fake signals. To avoid such false signals, we use these 3 moving averages. With this in mind, we still do not use moving averages alone for trade entries, but pair them. We discuss the 3 main steps of the moving average. This strategy gives late entry signals, but when it does, it is considered a safe position. Do not forget to control your emotions and master your trading mentality. Indicators are not supposed to predict the market for us, they are supposed to confirm. We use these 3 moving averages mostly as a guide to let us know in which direction to trade. Using indicators means mechanical trading. This type of trading is called mechanical strategies, that is, we open and close positions like a robot. We don't have any feelings about the ups and downs of the price or even the candles, we just follow a kind of mechanical strategy. It is better to backtest before any strategy. Try not to play any strategy on a real account without backtesting it. It may not match your trading personality and your account will be negative. Don't take strategy hard, strategy is a part of trading. If you enjoyed the video, please like this video and subscribe to our channel so that you never miss our new videos. Stay tuned for our next videos.